You know, one of the things we talked about also was this idea of balancing both the strategic objectives of your strategies, but also still being nimble enough to take advantage of what you view as opportunistic, investing. And I'm wondering, has your thinking in response to the global financial crisis, have you approached that differently now? Do you need to think about that differently, or I'd be curious to know your thoughts on that. Maybe Sebastian, we could start with you.
Yeah, I think I mentioned. I mean, I think we try and be as opportunistic as possible, and we often, if it means something that's probably doesn't fit in the liquidity basket of our quarterly liquidity vehicles, then we'll create a separate vehicle for that, and we've done that on 3 or 4 occasions. And I think being opportunistic, and particularly in the kind of markets that we see today, is a very, very important element. And we're seeing a lot of investors approaching us. I mean, to go to transparency, we see a lot more investors approaching us for separately managed accounts, requesting to coming to us and requesting if we could construct something that fits their portfolio. And I think that's a little bit of a shift. And obviously, we're much more willing, probably in today's world, to accommodate that. So I think being opportunistic, but also listening to your client, listening to what their needs are for their asset allocation, is an important element that we're dealing with a lot today.
Yeah, I would say, the appeal of opportunistic investing and sort of exploiting opportunities as they come up, the process that we use for evaluating them hasn't really changed a whole lot. I think what has changed recently are the types of opportunities that are available. But the actual process that we would use for evaluating them, I don't think has really shifted a whole lot.
Right.
I was just going to cover a couple of items that we looked at from an opportunistic standpoint. I know we mentioned converts before, but that's something we actually internally manage our domestic equity fund. So we actually did that off our own desk, and which took a little bit of assistance from different asset managers and different sell-side research firms. But again, that's where if you're a client, you pick up the phone, you call the folks that you trust, and you ask them for their assistance, and they help you. But along the same lines, after we've done that, we've also looked at the Build America bond space. We were one of the earlier investors in that space, and then we've actually, I think we're the 4th largest holder of those bonds to date. Again, it was a good opportunity and something that's yielding 200 over treasuries. It's not a bad place to be when you need long duration bonds. That's something we critically needed, and it's a space where we can take advantage of an opportunity and actually implement it rather quickly. I think the last thing that I would highlight would be something we did with the PPIP program when the federal government was looking to push forth that program. We looked at a number of the managers. In fact, we did a summit with a number of other states and looked at the organizations. And after we finished it, we got a call from another investor who said, here's what we structured for this, and what do you think? And it made a lot of sense to us. And we actually ended up looking at something very similar like that and implemented something similar to that later on. But it wasn't something that was out of the box, and it wasn't a shop that picked up the phone and said, here's our latest product. They picked up the phone and called us and said, here's what we think, could this work for you based upon your expectations? And they helped us craft it. And it's a pretty powerful idea where you don't try to come in and just sell us your latest product. Ask us what we really need, what we're trying to accomplish, and believe it or not, we probably might take you up on it.
Before we open the floor up to questions, I would be curious to know some of your current views on the market. We've talked about the impacts of the global financial crisis, the problems, some of these responses related to increased transparency, looking at risk in new ways, also level setting perhaps some of the return expectations you have. But in some of the panels that preceded us, there was a lot of talk of emerging market being an area of growth, and that's where the growth lies. Granted, that could come with higher volatility and risk. And I'm wondering what you guys think are some interesting options. Ray, you've described a couple. So maybe, Andrew, we can start with you of where you see opportunities.
Well, I guess rather than say opportunities, I would just focus on a puzzle in the sense that I don't understand how to reconcile the price of gold with the price of government Treasury bonds. In the sense that to the extent that the price of gold is motivated in part by concerns that people have around either inflation or the world coming to an end, it's hard for me to then understand why yields are so low. So that to me would be sort of a puzzle, and I suppose there's an opportunity there somewhere.
Yeah, I think we continue to see an opportunity in emerging markets. We have a very good and long-running Asia strategy, it's a Pan-Asian strategy, equity long and short, and it does some converts and event. In Asia, we think there's our multi-strategist allocated some more capacity to that. We think there's some interesting things happening in Asia. There's some definite alpha to be generated in some of the Asian markets. We think there's some interesting things to be done in the credit markets. As I mentioned to you, we just did a senior loan fund. We've come into market with a second lending fund to mid-sized companies. So we think opportunistically in the credit markets there are not everything. We don't like the high yield market right now, but we think in certain areas in the credit market being opportunistic, we're hesitant to be short the credit market at this moment. You seem to get your tail between your legs every time we try and look at an opportunity on the short side of the credit market. So, but we think there's some interesting opportunities in the credit markets. And then again, we like, actually this is a product that a very large institution came to us, and we're looking at a way to, they wanted something uncorrelated to CTAs to be able to get long directional exposure to the commodities market. And we went to our macro group, who had a very good track record in commodities, and we asked them, could you construct something that would, give us sort of 80 to 90% of the commodity indexes, but do it with a lot less vol and with a good, better Sharpe ratio and better drawdown numbers. And we've actually come up with something that's now got a 3.5-year track record. It's accomplished its goals and allows clients to get long commodity exposure. We trade 36 commodities in that, and I think we think it's a very interesting strategy right now. So commodities is something we've increased our allocation in multi-strat also.
I think the opportunities that we see today are, a lot of folks are going to focus on emerging markets, but a pension plan's got certain restrictions around that. We can only invest so much in the emerging market space. But we have looked at how to take our domestic investments and focus on companies that are, if you will, tilted to generate most of their revenues or a large proportion of their revenues from the emerging markets. And so there's a sort of a hybrid way to attack the problem. We're also looking at a variety of different strategies in the credit space, RMBS, CMBS, distressed debt in a number of places, as well as, believe it or not, real estate. I think those are the opportunities we're looking at now.
Great. Well, I'd like to open the floor up to questions from the audience.
Oh, great.
Richard Wright, RBW Capital. As AA bonds by sovereigns such as Japan are downgraded, what do you see the impact on equity markets and the Japan Postal, as they increase rates from 3.1 to 4.3%? How do you see any opportunities with the fact that they have a large percentage in JGBs allocating to hedge fund managers that are selling bonds? Thanks.
Yeah, I'm not an expert in the Japanese market. We brought down our allocation in Japan slightly. We've generated very good returns both on the short side of the market and long side of the market, but I wouldn't be able to answer that specific question. I can refer you to my PM if you'd like to.
I'll do the same.
I'll actually do the same as well. We did bring down our Japan weighting, but I'm not an expert in that area.
When it comes to asset allocation, and you talk about a new paradigm, isn't that we've seen this before, and it was 2002? Are we ever going to learn our lessons? I mean, we had a tech crash, we had Enron, we had the world coming to an end, we had us going to a war, people lost millions of dollars, people who were worth $100 million one day were worth nothing, and 6 years later, we have basically the same thing, but it just stretched globally. Do you guys have any reason why we have such a short memory?
Wow, that's your.
I think you look. I don't think. I can't answer for everybody. I can't speak for anybody else. I can tell you that we haven't had a short memory. We don't run our quant strategies anywhere near the leverage that we ran them pre-August of 07. We used to run them around 4 times. Today we run them around 2.5 times. Less return, but we're content with the Sharpe ratio we're going to produce for our clients. Our diversification in our multi-strat, I think, is greater than it was going into the crisis. I think that we're running it at a lower leverage. We have a lot more liquidity in that vehicle than we did pre-08. I think that we're doing a lot of work on our risk side to make sure that not only the correlation among the strategies in that product are less, but also among ourselves and other competitors out there. So I can tell you we learned a lot of lessons in 08, and we think we're much better structured today than we were. We extended the, today if you look at we had quarterly liquidity in our multi-strat. Today we have a 6-month initial gate, and then we offer 25% of your investment is released. So it's an investor side gates. 25% per quarter, you get out in a year in total. So, some investors may not like that, but we think that's a better match to the kind of liquidity that we have in our underlying portfolio. That wasn't the case pre-08. So I can tell you that, I think people have a fickle memory. There's no doubt about that. But I think we've had a huge learning experience from 08, and our portfolios look dramatically different than they did pre-08.
Yeah, I guess I would have a mixed view on that in the sense that I do think people learn from these types of events, and I think policymakers respond as well, changing laws, regulations, and things like that. But of course, no two bubbles are exactly the same. So you sort of adapt or learn to protect yourself against one type of bubble, but then something else comes along. So I guess that's what makes life interesting.
A couple more.
Okay.
So the horizon for investment managers seems to have shortened quite a bit over the last few years. Is the horizon for asset allocators shorter also? Do you see the move from 10-year, 20-year policy allocations shortening to be more tactical?
I would say it's a blend actually, in the sense that I think that investors still do have a very long horizon, particularly kind of from the strategic perspective. But as we've discussed, I think people are also very opportunistic, and I think opportunities naturally have a much shorter horizon. So it's a little of both, long-term from a strategic perspective, but then also very tactical, a little bit shorter term.
Yeah, I think our time horizon is the same. I think in certain environments, we definitely shorten our time horizon. I think what we've seen this summer has been clearly a time when we've cut down risk and brought down gross exposures across our portfolios. And probably our time horizon was shortened just by the things that were happening in the marketplace, both fundamentally and in a macro sense. And so I think there'll be periods where we do have a shortened sense of a time horizon. But in general, I wouldn't say over the long run that that's the case.
Right, and just from a pension fund's perspective, I can tell you we will still look at tactical opportunities as they come along. It doesn't mean we'll invest in every one of them, but it's something that I think a lot of large investors are focused on because of, if you will, the 5-year bubbles that seem to happen so often now, as opposed to a 10-year strategic plan. You still want to have that opportunistic bucket, if you will, to go after these opportunities and take advantage of them. Those are sometimes the best places to one, also learn from these issues, but also help boost your returns. So you still have to be focus on your long-term plan, but at least not be afraid to take care or take advantage of an opportunity when it comes along.
Hello, thank you. I have a quick question about oil prices. In light of similar argument between gold and the short-term treasuries, is there something going on in oil that's not consistent with the rest of the commodities and gold and the growth rates, or is it pricing and the proper expectations and your views?
I guess I'll take that one since I mentioned gold. I should know better. But, what I've noticed recently is that it seems as if oil prices have been moving very much in lockstep with equity markets. And I think that, in a sense, makes sense because, energy is such an integral part of our economy now. And so, for the most part, I think the two are going to move closely together. And that's sort of what I would expect. And so I don't really kind of see anything too puzzling in that dimension.